Okay, so people talk about this 4% rule quite a lot. So basically, no matter what the size of your portfolio is, if you're still investing in a portfolio, you can safely take out 4% per year. So that's why retirement experts often talk about that, because once you hit like $1 million, it's kind of like the grand target thing, most people say, in that field. So once you have $1 million, 4% per year is $40,000 a year lifestyle, whilst also being able to maintain the value of the entire $1 million. But if people are living longer, they still need to be more aware of sticking within the 4% goal, because a lot of people, when they retire before they're like 70, some people can get too carried away, spend too much early, which is going to mean that actually they might not be able to continue that rate of spending and might have to drop it down pretty fast. And yeah, like I said before, after 45, you should be reallocating funds from individual stocks into more secure bonds and index funds, basically just reducing risk again in the entire portfolio. Okay, so next slide. Okay, you've got your individual stocks, which are usually broken down as follows. So you've got growth stocks. These are higher risk but have a lot more upside. Companies like that are new tech or kind of like emerging sectors like AI, just stocks like that. Like Apple was a growth stock, but now it's kind of matured and it's pretty much becoming more of a value stock kind of in a way, although it's a lot more risky than kind of what people generally regard as like a foundational value stock is like Walmart, or like some company that's been around for a long time that's a lot less volatile, because Apple still can move like 3-4% in one day, which for an older investor would be a lot of money and a lot of risk for them probably. So yeah, you've got growth, dividend stocks. Okay, so retired people like dividend stocks. Dividend stocks, that's one of the critical things about them, is they pay a high dividend yield. So dividend yield being the percentage but you actually get paid like secured in the dividend itself, which is different to the actual underlying price of a stock. So if I'm invested in Apple, if I have one share of Apple and I get paid a 3% per year dividend yield, then I would get paid 3% of my investment on a quarterly dividend 3% per year rate. And every quarter, all these companies can readjust their dividend. They could increase the dividend, they can reduce the dividend, they could get rid of the dividend completely, which is like a whole nother subject. If they do that, that's quite a bad sign from the company. But we'll cover more of that later. So yeah, growth, dividend, value stocks, like I was saying, is the more secure, less risk, but less exciting stocks that you might like more if you're retired. Technology is basically its own entire category, especially like today. Technology companies are getting bigger and bigger and bigger. Apple, Amazon, Microsoft, Facebook, all now trillion-dollar companies, so they themselves compose a massive part of the entire index now. Only the top 5 companies of the S&P now are about 22% of the entire market value of the S&P 500. And then this is like a specialist category, angel investing. If you happen to be able to angel invest in a very promising company, this is where you can make the crazy home runs, basically. So if you were lucky enough to be an angel investor in Coinbase, for example, that recently did their IPO, direct sale, if you could have gotten in the 2012 first fundraising round, Gary Tan, who has now become quite a famous angel investor, his $300,000 investment in 2012 is now worth as much as $2 billion, which is over 6,000x. So that's like the super home run. Even if you have like $1,000 or $2,000 in an angel investment company, that could be $1 million plus home run quite easily if they really do well like that. and you get to sell on IPO day or after. Okay, then index stocks and ETFs. These can spread across industries, countries, or even, you could break this down further as well, but like mostly I'm just going to say, so you can get ETFs that are technology only, ETFs that are crypto only, ETFs that are consumer services only. You can get country index stocks, so you've got the S&P 500, the Dow Jones, and NASDAQ, which are all American listed. They don't all do business in America, but for almost all of them, the majority of business is in America. But you've still got like, you've still got NEO, BABA, which are still listed in America. And you can also get access to foreign companies by way of a ADR, which means you pay for the stock in American dollars and it moves in American dollars, so you don't have to take on any further currency risk as well. So that can be good as well with having risk spread across different countries, so you're not overly exposed to the US economy or the UK economy or any others. So then cryptocurrency. So obviously like quite a new part of the portfolio. Cryptocurrency has only existed since 2008 as we know it, with Bitcoin being the first major cryptocurrency. And you can spread risk across coins. You can spread risk by staking different coins and different holding portfolios and platforms. You can swing a bag between one coin to the other. So you don't have too much money at one point in one coin. And then NFTs as well even. Cryptocurrency has expanded so much now that NFTs are even becoming their own major segment of the entire cryptocurrency market, with trading volume being multi hundreds of millions right now, only in NFTs, not just cryptocurrencies themselves. Bonds. So I'm not personally invested in bonds at all. It's generally for people who are 45 and above, especially people who are like 60 and above. If you're coming towards retirement, you're probably a lot more likely to be interested in bonds. Government bonds, like American bonds, are regarded as AAA, pretty much completely risk-free. But of course, with being risk-free, the rate of return is a lot lower. So that's why I say for older investors generally, rates of return can be very low, can be only 2-3% per year, which in terms of high inflation, you could even be losing money, is the unfortunate part with that. Because inflation itself is taking money away from all of this. Like the actual real value of that money is disappearing every year with inflation. So it's an uphill battle with that. Gold is generally regarded as a hedge against inflation, although like gold itself is also quite volatile, really. Right now it's pulled back a little bit. It's about 10-15% down from all-time highs as of now. A lot of older people like gold, generally regarded as a store of value, inflation hedge. It's also very good to trade if you are interested in trading gold, then you can also do that.